Active is key. Everyone's looking for opportunities. Let me start you off of course, we're looking ahead to the non-farm payrolls. If it does seem like all systems are go in the US, how concerned really do markets need to worry about a taper-driven pullback?
Well, ultimately, we found that in rising growth and inflation environments, equities tend to do well, but this is an aggregate. And what investors really need to be careful of are really two things. We think that you need to be disciplined on valuation because obviously when rates go up, that does put some pressure on multiples. And what inflation gives with one hand, which is more growth, it takes away with the other, which is valuation multiple. On the growth side, we do agree the growth outlook is very, very strong. But we think that the narrative so far has been almost a bit complacent on cyclicals in that everyone focuses on the upside earnings momentum of cyclical companies. But what we found is that when there are significant pricing pressures, especially for producers, it's important to focus on businesses that can control their own destiny and their own profitability. And so we continue to lean into quality at this stage of the market cycle.
So, David, that takes me to one of your most constructive positions, which is finding value in the Chinese market. Does this mean you think the regulatory overhang and some of the leverage issues that are well documented are over, or are you simply avoiding those sectors?
Well, I think the framing of how people have been looking at China is a function of what people have been buying and owning. While I fully understand why people think of China as a technology-first market, and it has been very growth-oriented, there are parts of the market that have been neglected. And I think there's this widespread perception that China is basically two markets that are very bifurcated. You have the banks on one side that are really cheap, that bring down the valuation of the market, and then you've got all the tech stocks. But actually, there's a lot in between. There's a lot of really fantastic industrial companies that are actually cheaper, for instance, than their U.S. counterparts that are actually offering growth rates that remain very, very attractive for the medium term. And those are the types of businesses that we would be recommending people take a look at again.
In the meantime,
it's old China.
While you have policymakers trying to tamp down on some of the speculative behavior in the markets, whether it's on some parts of the equity markets or commodities market, or even trying to rein in the yuan strength, as this GTV chart on the Bloomberg shows, really those bullish forecasts for the yuan also starting to come down. What are the implications of that? Well,
being fundamental bottom-up investors, we look at equity markets typically in terms of local currency earnings growth potential. And we are not actually seeing that there's going to be a tremendous headwind to Chinese equities from a little bit of renminbi strength in the same way that people had perceived the U.S. to face over the last few years from dollar strength. We're quite happy to own many of the companies that we would broadly classify as value stocks in the Chinese market. But it does mean that some of the overhangs on certain types of high quality industrial companies in the U.S. And in fact the market overall will probably face less headwinds on currency than perhaps has been perceived. That doesn't matter that much when earnings are up 40%, but when we're talking about 2022, which we know the market is looking at as a a forward discounting mechanism that does come into view.
So as a fundamental bottom-up investor, what do you make all of this meme stock frenzy? Because I'm not just talking about here in the US with AMZ and GameStop, but also Indian retail investors, Korean retail investors getting in on the rally.
Sure, Sherry. I think it's a fair characterization that there is a global phenomenon of excess liquidity in markets leading to a lot of speculative behavior. But ultimately, we know that if you are long-term in how you look at markets, these types of opportunities are very much caveat emptor. We would not be looking at them, given the fragility of some of their business models. And we very much continue to prefer businesses that have a proven ability to deliver earnings and profitability through cycles.